In the wake of the 2008 financial crisis, as governments around the world bailed out banks and printed unprecedented amounts of money, a mysterious figure known as Satoshi Nakamoto published a white paper that would change the course of financial history. Titled Bitcoin, a peer-to-peer electronic cash system, this 9-page document laid out the blueprint for the world's first cryptocurrency. But what Bitcoin was designed to be and what it has become are two very different stories. Today, we'll explore Bitcoin's journey from a fringe digital payment system to a globally correlated financial asset backed by data spanning from 2009 to 2025. Is it still what Satoshi envisioned, or has it evolved into something completely different? Satoshi Nakamoto's vision for Bitcoin was remarkably straightforward. Create a decentralized digital payment system that would allow people to transact directly with one another without requiring trusted third parties like banks. In the white paper's abstract, Nakamoto described Bitcoin as a purely peer-to-peer version of electronic cash that would allow online payments to be sent directly from one party to another without going through a financial institution. The timing was no coincidence. As Satoshi wrote in Bitcoin's Genesis blog, the Times 3rd January 2009 Chancellor on brink of second bailout for banks. This embedded newspaper headline made it clear that Bitcoin was, at least partially, a response to the financial system's centralization and what Satoshi saw as its inherent fragility. Bitcoin would run on a new technology called blockchain, maintained by a network of computers around the world rather than any central authority. It would have a fixed supply of 21 million coins, making it immune to the inflationary pressures created by central bank money printing. In those early days, Bitcoin was primarily conceived as a payment system, not an investment vehicle. As Bitcoin began to gain traction, its narrative underwent several transformations. Let's track this evolution. 2009 to 2013, digital cash for the internet. In its earliest days, Bitcoin was championed by cypherpunks and libertarians who valued its potential for financial sovereignty. The primary use case was facilitating censorship-resistant transactions outside the traditional banking system. Bitcoin was digital cash, used on platforms like Silk Road and as a means to bypass capital controls or banking restrictions. 2013 to 2017, digital gold emerges. Following the 2013 Cyprus banking crisis, a new narrative began to take shape. Bitcoin's fixed supply of 21 million coins was increasingly compared to gold scarcity. The term digital gold entered the lexicon, and Bitcoin started to be positioned as a store of value rather than primarily a medium of exchange. The scaling debates of 2015 to 2017 further cemented this shift as the community wrestled with the trade-offs between Bitcoin as a payment network versus a settlement layer and store of value. 2017 to 2020, institutional interest and hedging narratives. As the 2017 bull run brought Bitcoin into mainstream awareness, a new narrative emerged. Bitcoin as an uncorrelated asset that could serve as a portfolio diversifier. Investment theses from firms like Grayscale emphasized Bitcoin's potential role in institutional portfolios precisely because it supposedly didn't move in sync with traditional financial markets. 2020 to present, inflation hedge and macro asset. The COVID-19 pandemic and subsequent monetary expansion supercharged a new narrative. Bitcoin as an inflation hedge. With governments and central banks expanding money supply at unprecedented rates, Bitcoin's fixed supply made it increasingly attractive as protection against fiat currency debasement. This evolution raises important questions. How much of Bitcoin's narrative shift was organic versus retrofitted? And more importantly, does the data actually support these evolving narratives? To answer these questions, I analyzed 15 years of daily closing prices for Bitcoin, the S&P 500, gold, the US dollar index, and the global M2 money supply from 2009 to 2025. And boy oh boy, the results challenge many common narratives about Bitcoin. Finding number 1. Bitcoin has a strong positive correlation with stocks of 0.9. Despite being marketed as an uncorrelated asset, Bitcoin shows a remarkably strong positive correlation with the S&P 500. This 0.9 correlation indicates that Bitcoin and stocks move together to a significant degree, challenging the diversification thesis. Bitcoin is perceived as a so-called risk-on asset by market participants. Finding number 2. Bitcoin does correlate strongly with gold, 0.84. The digital gold narratives find some support in the data. With a 0.84 correlation to gold, Bitcoin does appear to share characteristics with a traditional precious metal, suggesting that the store of value narrative has some empirical backing. Finding number 3. Bitcoin rises with money supply expansion, 0.82. Bitcoin shows a strong positive correlation of 0.82 with a global M2 money supply, supporting its positioning as an inflation hedge. As central banks expanded the money supply, Bitcoin indeed rose alongside this expansion. Finding number 4. Bitcoin has a positive correlation with the US dollar. Perhaps most surprisingly, Bitcoin shows a moderate positive correlation with the US dollar index. This challenges the narrative that Bitcoin necessarily trades inversely to fiat currencies and suggests a more complex relationship, something that might be worthwhile to analyze further in the future. These findings paint a picture of Bitcoin as a multifaceted financial asset that defies simple categorization. Bitcoin is no longer an isolated ecosystem, but has become fully integrated into the global financial system. It responds to many of the same macroeconomic forces that drive traditional markets. The correlation with gold validates aspects of a digital gold narrative, but Bitcoin's stronger correlation with equities reveals risk asset characteristics that gold doesn't exhibit to the same degree. The strong correlation with M2 money supply supports Bitcoin's positioning as an inflation hedge, suggesting it has functioned as intended during this period of significant monetary expansion. Bitcoin's strong correlation with equities challenges the narrative that it serves as a traditional portfolio diversifier. Investors seeking pure correlation benefits might be disappointed. Above all, Bitcoin shows high sensitivity to monetary policy, suggesting that its price action is deeply connected to the broader monetary environment. Bitcoin's journey from Satoshi's simple peer-to-peer electronic cash to today's correlated macro asset reflects the natural evolution of a new financial instrument as it integrates with the global economy. The data suggests that Bitcoin has indeed become a store of value and inflation hedge as its narrative suggested. But it has also become something Satoshi likely never anticipated: a mainstream financial asset that moves in sync with traditional markets. This doesn't diminish Bitcoin's revolutionary technology or its potential long-term impact. Rather, it shows how financial markets tend to absorb and integrate new assets into existing structures. As we look into the future, Bitcoin's correlations may evolve further as monetary regimes change. What's clear is that Bitcoin has matured from an experimental payment system to a sophisticated financial asset that reflects, responds to, and potentially influences the broader macroeconomic environment. For investors, traders, and Bitcoin advocates, understanding these correlations is crucial for setting realistic expectations about Bitcoin's role in the financial ecosystem. Thank you for watching. If you found this analysis valuable, please like, subscribe and share your thoughts in the comments below. Also, Yi Jian, San Lian, take care and goodbye.